this is Indranil Pan, Chief Economist at the Yes Bank. We'll be talking to you on the monetary policy that just got announced. For context, the Reserve Bank cut the repo rate by 25 basis points and kept the stance unchanged at neutral. There was one person who had looked at the stance as being accommodative, but it was a 5-1 vote in favor of stance being at neutral. So what did guide the Reserve Bank to cut the repo rate today? Inflation has definitely dropped quite significantly, led by the vegetable prices, which has been continuously dropping for the last 8 to 9 months, while GST cuts have also added another round of implication for the downside bias in terms of the headline GDP inflation number. Inflation was at 0.25% in the last reading, which was a sub 2%, which the RBI tracks as the lower bound of its inflation targeting regime. Therefore, there was room available for the Reserve Bank of India to cut the rates, and the Reserve Bank of India decided to bite the bullet at this point in time, even though the Q1 and Q2 GDP growth were quite firm. In fact, the first half GDP number was 8%. The RBI did accept the fact and acknowledge that even after the Q2, Q3 and Q3 early indications of growth are also robust, and expected that the robustness in the growth will continue given that Rabi sowing has started in a good fashion. The soil, the moisture levels are good, and urban demand also remains resilient. The RBI also acknowledged that there was some pickup that was happening in the private sector investments. However, having said that, the RBI did acknowledge that there could be some downside risk to growth given the uncertain external atmosphere, and also pointed out the importance of the trade deals between India and other countries to provide a boost to the growth. The reforms process, as the RBI pointed out, also would have added positively to the growth bias in the economy. So even as the growth was strong, the RBI actually decided to look at the much lower inflation prints to decide on the rate cut story. Having said that, let us look at how RBI is likely to be looking at the rate trajectory in the days ahead. First of all, I have pointed out about the growth projections. Growth is likely to remain strong. On the inflation side, the RBI has reduced its forecast for FY26 inflation to 2% from the earlier 2.6%, which is pretty much close to where we are also looking at inflation in the current financial year. For the next financial year, the RBI has given projections for just the first and the second quarter, which are about 3.9 to 4%. Broadly, in terms of the assessment of the Reserve Bank of India, the inflation will remain anchored, and both the headline and the CPI inflation would be close to the target of 4%. Having said, therefore, the RBI being confident of maintaining the 4% level, the bar for the future rate cuts remains relatively on the higher side. We at Yes Bank, we are not looking at any further rate cut in February. February is also likely to be an important policy because we will be seeing the union budget before the RBI meets for the policy, and the RBI will be looking ahead to changes in the CPI and the GDP in terms of the weighting diagram and the way it is calculated, and a new series will emerge for the future in February. So keeping all that in consideration and acknowledging the 25 basis points rate cut that has been done today, we think that the bar for the rate cut is high and there is no further rate easing in the current cycle. Thank you very much.